Hey guys, a new video from the All-Rounder. A great man once said that change is the only constant. One thing that has changed a lot through the last few years is investing. People have really started to realize the importance of investing and its significant contribution towards financial independence. And so in today's video, we'll be talking about the evolution of investing through the last few years. So I am Prabir and you're watching the All-Rounder, so let's get started. After some conversation with elders, I discovered that 40 years back in India, investments majorly were jewelry, bank deposits, real estate or perhaps land. This was majorly because most people did not want to take risks, and the ones who were willing to take risks did not have any domain to really invest their money. And this was primarily because of two reasons. The first is a psychological aspect of it. Most people could not even digest the fact that their hard-earned money was just being blocked somewhere, even though they could potentially earn some returns on it. Instead, they prefer to invest that money into tangible assets like jewelry, just because of the psychological feeling of assurance that it gave them. And the second reason is that back in those times, it was relatively difficult to invest in the stock market or any government bonds per se. And the flow of money was extremely restricted in India. A few years passed by, and in the 90s, the exchanges were moving to digital means. Banks also started to offer portfolio management services to their high net worth individuals. Slowly and very slowly, people started to realize the importance of investing. But more importantly, the importance of diversifying their portfolio. The people started realizing that only investments in jewelry and bank deposits wasn't going to yield them much returns. And so about at this time, 1 to 2% of the Indian population actively invested in stock markets or any equity related markets. Then in the early 2000s came the technological revolution, and the Indian government heavily invested in digital infrastructure, and this yielded high returns. There was a significant rise in the investing population of India, and about 4 to 5% of the Indian population actively held stocks at the time. And there are numerous factors that deserve credit for this revolution, but I'll be talking about the most significant ones. So the first factor is the technological revolution. The technological revolution played a pivotal role in the rise of investors. The launch of NSE's online trading systems in the early 1990s and the launch of trading apps like Zerodha in the late 2000s meant that anyone with an internet connection could trade in the Indian stock market. Additionally, the introduction of DMAT meant that there was no need of any physical share certificates. For anyone who does not know what DMAT stands for, it is dematerialized account, and it holds all the investments and securities of an individual. Systematic investment plans also made it more easier and accessible for the public to invest into the stock market. A systematic investment plan is when a fixed amount of money is deducted from your bank account on a fixed period, like every month or every 3 months, on a fixed date, and is invested into the stock market either through mutual funds or directly into individual stocks. The second factor is economic reforms and liberalization. The Indian government opened the doors for foreign direct investment in the early 2000s. This resulted in the involvement of many foreign institutional investors and the introduction of many new companies in India. The money circulation in the equity markets and India as a country has shot up. Fast forward about 25 years, and today we can't even count the number of investment options we have. And I feel all this was a cycle. As people got more financially literate, they felt the need to invest, but more importantly, diversify their portfolio. They wanted more and more avenues to invest their money. Governments and entrepreneurs identified this demand-supply gap. And today, there are so many microfinance, lending and portfolio management companies for the same reason. Today, there are approximately 50 different avenues of investment, and each avenue has many subparts within them. Another key reason supporting this rise in investors is the fact that people's spending has also gone up. There are so many different avenues to spend your money in contrast to 20 years back. There has also been a shift in the mindset. People are less conservative about their money nowadays. And so, to support this increased level of spending, people are using investing as a passive income source which can complement with their primary income source so that they can continue to sustain this level of lifestyle. The last 30 years or so have transformed the way the world invests. Today, the world's financial literacy rate stands at about 28 to 30%. And there is no doubt that as we progress further, the availability of information will be even more. And so, the investing sector is definitely going to see a green curve until the foreseeable future. Of course, with a few hiccups here and there. To end, I would like to say that investing has evolved from being an activity only for the elite to being a powerful tool for each and every common man. Don't forget to subscribe, like, share, and hit the bell icon for more interesting videos. Thank you.